let's start there with, what are some of your big, thoughts recently as you kind of, stick your head above ground and say, like I'm seeing some things here. I think I need to let some people know about this.
Yeah. Okay. So yeah, that's a lot of stuff. So I'll try to be as concise as I can be. And to your point, there's so much noise in the world right now, and I'm really trying hard not to add to the noise. I want to add signal where I can, and when I don't have signal to add, I just don't want to say anything, and so I kind of keep to myself. So it's really tough to talk about macro and to look at where the market is headed when you have the type of administration that we have. Okay, so I want to say from the front, like I generally agree with most of the Trump administration's policies. However, we are experiencing the most centrally controlled, centrally planned economy that we've experienced probably since the 1930s. And that's pretty wild to say, right? Like
That's wild.
we live in a time of there's massive inequality as far as incomes are concerned. We have this K-shaped economy that everybody talks about, the haves and the have-nots down here, the owners and the renter class down here. The bottom of the K is struggling massively. And so I just want to be like super cognizant of that, and just let people know like that's what we're working, that's why we're here, right? That's one of the reasons why us Bitcoiners are out here talking about Bitcoin on a regular basis, because that can help close the gap that government fiat and fiat policies create. They create this massive inequality. So it's the age of populist leaders. Trump is like the perfect example of the ultimate populist leader. These are the kind of times where in history, if you're into kind of the fourth turning type cyclical history, like Neil Howe and these guys, the things
Mm-hmm.
that they talk about, I really believe we're in a very significant period where the world is changing rapidly, and I think that most people are still missing what's happening. So that's kind of first. That's my overarching thing. And I also want people to understand, like, I am not generally political. Like, I don't care about politics, but we're in a time period where politics are moving quickly. The executive orders that the Trump administration is unleashing, again, which I generally agree with the direction that they're moving. However, anytime you have central planning and you're throwing that onto a free market, you're distorting free market economics. Case in point, just this morning is the new pharmaceutical basically price controls that we're going to see, and that just is hitting the wire right now, that Trump is unleashing. It's a good thing in general because pharmaceutical prices in the US are just massively overpriced and distorted, but it's not a good thing, I think, that we're doing price controls. And
Mm-hmm.
and we keep doing these price controls, and even if you think the direction of the price controls or the underlying purposes and reasoning for price controls is a good thing, it's still distorting the free market. And I'm a free market economist, so I don't like to see that. Okay, so that's all that kind of stuff. So macro, why does all of this stuff matter? I think it matters greatly with where we are right now. People talk about the fiscal deficits that are being run. People are looking at Doge and thinking, is this going to be the answer? I will say that Doge is a drop in the bucket for the amount of fiscal spending that's going to not only continue but to accelerate from here if these tax cuts get pushed through, which again, I'm a huge fan of tax cuts. I pay a lot of taxes and I hate paying taxes. I think the federal government should get much smaller, like 90% smaller. But the tax cuts that are coming, if they don't decrease major other expenses like Social Security, like Medicare, things like that, we're going to blow out the fiscal deficit. And what blowing out the fiscal deficit means is borrowing money that the government doesn't have. And what that means is we're going to debase the US dollar even more. Okay, so that's like the whole grand scheme of things. One other guiding principle that I follow that I don't see many other people talk about, I know that Lynn Alden has done some work on. She's always like about a year ahead of me on her takes on the economy and where we're going. I'm a little slow, so it takes me a little longer to figure things out. But one thing I just cannot take my eyes off of is if people, and I would encourage people to do this at home, get a long-term chart of the S&P 500 and price it in gold. So SPX divided by gold, and put it and look at a 100-year chart. And if you do that, you will be amazed at these huge cyclical trends that we see. And when you look at that, I would say, and this is the concerning part, is that we are basically back to a period similar to the 1930s, similar to the 1970s, similar to the 2000s. And now here we are at this current age where basically stocks are falling in real terms. So they're falling in terms of the price of gold. And once you have those kinds of momentum shifts, they actually tend to go on for about 10 to 15 years at a time. So this is really remarkable. So it's a time period where I think, we've heard other people talking about this, is U.S. exceptionalism dead, right? Everybody's pulling money out of the U.S. And so we're seeing that be affected, in the price of stocks and things like that. I think that this general trend of U.S. financialization, I think it peaked back in 2021, at the end of 2021, similar to 1929, similar to about 1968, similar to 1999. And if you ask any person who studies economic history, would you in general say that the 1930s and the 70s and the 2000s, the aughts, were they generally good or generally bad for America, for the American economy? I think most people would say those are kind of bad years, right? The 30s, we think of the Depression, the 70s, the oil embargoes and all that, the
Inflation.
Vietnam War ending, we got off the gold standard, all that kind of stuff. Kind of tough times, the 2000s even, but even that was sort of distorted because of the blowing up of the housing market. But if you were a tech investor, you just got crushed during the 2000s. I think we are back in, and it's not even are we entering that period. I think clearly when you look at these sorts of longer term charts, we are well into that period where basically peak U.S. financialization, we've already reached the peak, and we're rolling over now. So what does that mean practically? This is a really long answer to your short question, but it kind of encompasses a lot of what we were talking about.
Yeah.
I think for the next decade or so, similar to, and I think probably the best analog that people can like conceptualize is it's going to be like the 1970s. So what happened in the 1970s, right before the 1970s, we had peak Nifty 50 stocks. So there were 50 US stocks that were the growth stocks back in the 60s, 50s and 60s, that basically all you had to do was buy the Nifty 50 and you would just make money. That's just how it was. Similar to how the Mag 7 stocks have been over the last 15 years or so since the global financial crisis. All you had to do is buy the Mag 7 and you just crushed it. But what happened afterwards is we had basically a 14-year period or so from about 68 to 1982 where stocks in nominal terms did this, and in real terms, when you adjust for inflation, did this. They just got hammered, and bonds just got hammered. And the only things that did well were things like gold, other hard assets, and emerging market assets did well if you were pretty good at selecting those. The vast majority, and here's my main concern, and then I'll wrap it up. My big concern for Americans are they have the vast portion of their net worth in 401ks, 403bs, and IRAs, and they're in American stocks and American bonds. And they, I think, are going to get crushed. I think they've already started to get crushed relative to gold, so in real terms. So even if you're seeing a green number, a positive balance on your returns for the last couple of years, in real terms, when you factor in monetary debasement, you're starting to lose purchasing power. And I think at the end of 10 years from now, let's get back and do this again in 2035, and we'll see how we are. I think it's going to be very similar to how it was in the early 80s, where people are going to give up on stocks because they had 14 to 15 years or so of terrible returns. Bonds are going to get crushed. I think real estate has peaked and will not recover in real terms as well. So tons and tons of Americans have, VRBOs. They're renting out second, third, fourth, fifth homes. And what has that done is it's outpriced millennials and Gen Zers. They just can't afford a house, especially with mortgage rates sitting around 7% right now. The housing market is frozen right now because the boomers want to sell it for a huge profit, and the millennials and the Gen Zers don't want to buy it from the boomers because they can't afford it.
If you like that clip, then you definitely got to check out this next spicy clip. I think you're really going to like it. Come on, check it out. But if you want the full version, the full interview, then check that out over here. Come on, do it. I'll see you in there.